Houston, we have a problem.
Say again, please.
Houston, we have a problem.
That we do, man. That we do.
And that problem, chances are, you're a part of it. Lately, we have been watching what is happening with national credit card debt. Jonathan, it's turning into a behemoth.
It's massive. You've probably seen it in the national news. And right now, if you see the slide we have up on the screen, you can see that the credit card balances that are being carried over month to month, means they're not being paid down, is almost at $1 trillion.
It's crazy. We've never seen anything like it in the history of our country. So if you have a credit card, chances are you have credit card debt, or you have some massive balances that, you know, maybe you're paying it off every month, but these are huge amounts. And so all of that's going in, but the reality is we know that with inflation and with job stagnation, you know, wage stagnation really, people are struggling paying their bills more than ever right now. Yeah. So we've got a problem nationally. Chances are you have a problem individually. So Jonathan, how do we solve this?
Yeah, and the big thing about that problem, Austin, is credit cards are at 20 to 25% interest rate right now. Like, let's not forget to hit that on. So the problem we're talking about is not just the balances, but you're paying 25% interest on your credit card.
Yeah, people think interest rates are rough with mortgages right now. That adds
nothing
some
compared
fresh
to the
perspective.
credit cards. Yeah.
Yeah. How about tripling where mortgage rates are right now? That is brutal, and that's exasperating the problem, right? Because if you're having to pay 20% on what you owe each month, and you're struggling to make that payment, then what you owe is just increasing month over month. You're making minimum payments, or you're not making, you know, enough on it, and that thing is just snowballing.
Yeah, all that to say is we're here to help. So Austin, what's the solution we have for this big problem?
Yeah, so in lending terms, Jonathan, we call it debt consolidation. And so what we mean by that is we're taking your debts and going, how can we bundle these together, right? To use an insurance term, how do we bundle your debts together to help get it all down to a lower interest rate? Because 20% is awful. So how can we package those things together, get all of your debt into one umbrella, if you will, another insurance term, one umbrella loan where everything's all together.
Yeah, and the goal with debt consolidation is increasing your monthly cash flow. So Austin and I were talking earlier, it's like, hey, it's great you make $5,000 a month, but if you're spending $5,000 a month, or in some of these people's case, you're spending $6,000 a month.
That's right.
That's brutal. But the person who's making $5,000 a month and only has $3,000 of expenses, well, that person can save, that person can invest, that person can maybe go on trips and vacations. And so we want to use a debt consolidation loan to help increase your monthly income.
That's right. And so even though interest rates are super high right now, you might be surprised to hear that cash out refinances are starting to pick up. And this is why, and we want you guys to focus in on this. U.S. equity, even though credit card debt is at an all-time high, U.S. equity for the average American homeowner is at an all-time high as well.
Absolutely. So if you're looking at this chart we have on the screen right now, you will see that in 2022, we were at $30 trillion of equity in U.S. residential homes. And one of the craziest stats, Austin, you just said it, is that the average American homeowner right now with the mortgage has over $274,000 of equity, and that's a Q1 in 2023.
Yep.
So this video that we're shooting to help you with the debt consolidation is for the homeowner who should have equity. I mean, one out of three chance you have tons of equity, and then you got some credit card debt that we want to help provide a solution for.
I think statistically there's a 1 out of 2 chance that
There
you've
you
got
go.
a massive amount of equity. And so a lot of people, they're sitting on those low interest rates, Jonathan. They're like, but I bought or I refinanced a few years ago. I'm at 3%, maybe somewhere around there with my interest rate.
I don't want to give it up.
I don't want to give that up. But what you got to look at is you got to zoom out. You don't want to miss the forest for the trees. Let's zoom out. Let's take a look at all of your debts. And if you're paying 21% on your credit card balances, or you're paying 10% on an auto loan, like that 3% interest rate's really cute on your house, but there's a much better way to tackle that. And so, Jonathan, walk us through this scenario.
Yeah, so this is a very standard scenario. If you're looking at the slide I have on the screen right now, this is very standard. What we see as loan officers all the time is that we have a homeowner This house is worth $415,000. They only owe $270,000, so we have a good chunk of equity right there. 35% equity. Their principal and interest is only $1,350 because they have a 3% interest rate. But look down in the red. That borrower has a car payment.
Yep.
That borrower has some credit card balance over. And guess what? The federal government said as of October 1st, 2023, you got to start making your student loan payments. So this borrower has student loan payments. So their total monthly payment or total monthly debt obligations is $2,950.
Yep.
And we want to help do a debt consolidation. So here's what that would look like. You can pull out up to 80% loan to value or just retain 20% equity. So in this house, we did a max cash out refi, and we're able to get them $55,000, Austin.
Yep.
And so we can say what to that card note and that credit card and student loan with $55K.
Adios.
Bye-bye, bye-bye. And so we wipe it out, and yes, as you can see, the interest rate moved from 3% to 6.875 in this situation. But now their total monthly payment, Austin, is $2,181. So we saved them almost $770 of monthly payment, and that goes right into cash flow.
That's over $8,000 a year.
Yeah, so that's a huge increase. You're making $40,000 a year, $50,000 a year. We just got an $8,000 boost in your income.
That's literally, it's like getting an $8,000 pay raise. Who does not want that right now? I mean, that is huge.
And that's right now. What is going to happen in 2 years, Austin?
In the next 2 years, it is very safe to say that you are likely going to have a refinance opportunity, if not multiple. And so when that comes, then we're taking, okay, we've consolidated all of your debts into one loan. And obviously, it's a lot lower than some of the interest rates you're paying. It's a little higher than your current mortgage payment, but it's brought the total debt down. Then in the next 2 years, high probability, you're going to be able to lower the interest rate on that consolidated loan. And when that happens, we see that you're saving, gosh.
It almost doubles.
It almost doubles your savings. So now we're talking about moving from $8,000 a year savings to $16,000 roughly a year savings. Huge.
Yeah. And everything's consolidated in one payment. So.
And I want to say something too. Like, this is a very vanilla scenario, Jonathan.
Yeah, I've seen way worse.
We see some crazy credit card debt. We see crazy car payments. And student loans, obviously, we're going to see those start to increase. And so, and again, the 274, that's average equity. I mean, that means a lot of you guys are sitting on even more than that. And so this is a huge tool. Nobody wants to give up the low interest rate on their house, but you've got to look at the reality that whatever you're paying interest on is gone money. That money is adios. It's not working for you. It's not helping you. It's just costing you. Let's zoom out and let's try to minimize all of that money that you are spending that isn't going toward building principal.
Yeah, you nailed it on the head, Austin. At the end of the day, we're trying to help you keep more of the money you've already earned.
That's exactly right. So this is a huge tool, guys. If you're interested at all, or if you want us to run scenarios for you, please reach out. It takes us a few minutes to run this, especially if you're a past client. This is super quick and easy. So don't miss this opportunity. Don't get suckered into paying 20-something% on debt that you could easily consolidate.
All right, guys. We're always here to make more simple. See you next time.
Adios. Woo!